Service organizations differ fundamentally from manufacturing businesses because their primary output is an intangible service rather than a physical product. Nevertheless, effective cost measurement remains essential for pricing decisions, budgeting, performance evaluation, profitability analysis, and strategic planning. Management accounting therefore applies service or operation costing techniques to measure the cost of delivering services by identifying appropriate cost units and analyzing the resources consumed in service provision. In addition, modern organizations increasingly employ alternative costing principles, including activity-based costing, ABC, target costing, and life cycle costing, to overcome limitations associated with traditional costing systems and improve strategic cost management. Characteristics of service organizations. Service organizations possess several distinctive characteristics that influence cost accounting procedures. The most important feature is intangibility, meaning that services cannot be physically stored or inventoried for future sale. Production and consumption frequently occur simultaneously, requiring close interaction between customers and service providers. Service organizations are generally labor-intensive, relying heavily on employee expertise and customer contact rather than automated manufacturing processes. Quality often depends upon employee performance and customer perceptions rather than measurable physical characteristics. In addition, services exhibit heterogeneity, meaning that quality and delivery may vary between customers or occasions, making standardization more difficult than in manufacturing environments. Another important characteristic is perishability, whereby unused service capacity cannot be stored. For example, unsold airline seats or vacant hotel rooms represent permanently lost revenue opportunities. Consequently, capacity management and cost control become particularly important in service industries. Applications of service/operation costing. Service costing is appropriate wherever organizations provide intangible services rather than manufacturing physical goods. Common applications include hospitals, hotels, transport companies, airlines, banks, insurance companies, educational institutions, legal practices, accounting firms, telecommunications providers, restaurants, consulting organizations, and public sector agencies. For example, hospitals require service costing to determine treatment costs. Universities estimate teaching costs per student. Airlines calculate operating costs per passenger kilometer. And hotels measure accommodation costs per occupied room. Accurate service costing enables managers to establish prices, evaluate efficiency, allocate resources, and assess departmental profitability. Unit cost measures in service organizations. Unlike manufacturing organizations that commonly use cost per unit produced, service organizations employ specialized cost units reflecting the nature of services provided. The selection of an appropriate cost unit is essential for meaningful cost analysis and performance evaluation. Examples include hospitals, cost per patient day or cost per operation; hotels, cost per occupied room night; airlines, cost per passenger kilometer or seat kilometer; bus companies, cost per passenger journey or vehicle kilometer; electricity companies, cost per kilowatt hour supplied; restaurants, cost per meal served; universities, cost per student enrolled; consulting firms, cost per consulting hour. These unit measures facilitate comparison between actual and budgeted costs, while supporting pricing decisions and operational efficiency analysis. Service cost analysis. Service cost analysis involves accumulating all costs associated with providing services and expressing them relative to the selected cost unit. Total service cost generally comprises direct labor, direct expenses, consumable materials, and allocated overheads. The basic unit cost formula is, for example, if a hospital incurs total monthly operating costs of $2,400,000 while treating 12,000 patient days, the average cost per patient day equals. Management accountants compare these costs over time between departments or against industry benchmarks to identify opportunities for cost reduction and operational improvement. Alternative costing principles. Traditional absorption costing allocates overheads primarily using volume-based measures, such as labor hours or machine hours. However, increasing automation, product diversity, and service complexity have led organizations to adopt alternative costing techniques that provide more accurate cost information and support strategic decision-making. Activity-based costing, ABC. Activity-based costing, ABC, allocates overhead costs according to the activities that generate those costs rather than using broad volume-based allocation methods. ABC recognizes that products consume activities and activities consume resources. The costing process involves identifying major activities, accumulating activity costs into cost pools, determining appropriate cost drivers, and assigning costs to products according to actual activity consumption. Examples of cost drivers include number of purchase orders, machine setups, production inspections, customer deliveries, processing transactions. ABC produces more accurate product costs, particularly where organizations manufacture multiple products requiring differing support activities. It improves pricing decisions, profitability analysis, process improvement, and strategic cost management by identifying non-value-added activities and opportunities for efficiency gains. Target costing. Target costing is a proactive cost management technique that begins with the expected market selling price rather than the production cost. The allowable cost is determined by subtracting the desired profit margin from the anticipated selling price. Product design and production processes are then engineered to achieve this target cost before manufacturing begins. Target costing emphasizes cost reduction during product design, where the majority of future costs are committed, making it an important strategic tool in highly competitive markets. Life cycle costing. Life cycle costing, LCC, considers all costs incurred throughout a product's entire economic life, from initial research and development through design, production, marketing, distribution, customer support, and final disposal or withdrawal. Rather than focusing solely on manufacturing costs, life cycle costing recognizes that substantial expenditures occur before production commences and after sales are completed. This comprehensive perspective supports long-term pricing decisions, investment appraisal, product development, environmental management, and strategic profitability analysis by evaluating total product profitability across its complete commercial life. Comparison with traditional costing. Traditional costing systems primarily allocate overheads using production volume measures and concentrate on manufacturing costs incurred during production. While suitable for relatively simple manufacturing environments, they may distort product costs where overheads are significant and product diversity is high. In contrast, ABC allocates costs according to activity consumption. Target costing manages costs proactively through product design and market-driven pricing, and life cycle costing adopts a long-term perspective by considering costs throughout the entire product life cycle. Together, these alternative costing principles provide more accurate cost information, enhance strategic planning, improve cost control, and support sustainable competitive advantage in increasingly complex business environments.